Welcome back to Robinhood Stock Market Watchlist meeting. My name is Carlos and today is Sunday, January 8th, 2023. This is our live meeting that we do every Sunday, unless there's holidays going on. But we always like to go over certain events that create a lot of volatility, because it's always important to know what's going to happen before it happens. And so a lot of times, the best way to track that down is usually through usually it was news. Usually when you're a new trader or an amateur trader, usually we rely on a lot of news. And the problem with news applications is that by the time we get the news, it's too late. And so one of the things that pros say is always follow the money. And so and that can mean a lot of different things. That could be following activity, that could be following maybe like for example, like the news. And so where does the news get their news? And so we follow that, and usually when we see major volatility throughout the day, it's usually because of some kind of reported news. You'll notice that the news applications is then talking about maybe unemployment or maybe some kind of economic growth. Well, that all has to do with economic reports. And so all economic reports are scheduled to happen. And there is a couple different websites you can go to, but we like to use a website called investing.com. It's also an application. And if you're new to this meeting, you've probably heard us talk a lot about this in our chat rooms and our group. And so economic reports is extremely important because they have some of the biggest impact on our stock market. So it only makes sense to master economic reports, because this information is available before it hits the news. And we need to know what's going to happen before it happens. And so let's focus on this week. So if we click on this week, at first we're just going to see a lot of gibberish. We need to clear this up a little bit by clicking the filters icon, whether it's on the mobile application or the website. So once we click on that, we need to clear everything. There's only two things that we need to see, and that's we need to put a check mark under the United States, and then under importance, you'll notice there's a 1-star, 2-star, and a 3 stars. We want to put a check mark under 3 stars because we want to pull everything that'll have the biggest impact on the United States stock market. So we'll click apply, and then again we'll be able to see everything that's scheduled to happen this week that'll have the biggest impact on the stock market. So once we have that, then it's trying to determine, will it provide a bullish characteristic or a bearish characteristic for the stock market? So we see that there isn't anything on a Monday. And so, and that's normal. Normally we don't see anything on a Monday or a Friday. Usually it's on a Tuesday, Wednesday, and a Thursday. But every once in a while we might see something on a Monday or a Friday, or sometimes both. Just depends on how much they're trying to cram into one week. But this week it looks pretty. It looks pretty decent, for Monday. It's kind of like a wild card. We don't really know, what Monday's going to be. It could be, kind of recovery type of day, or it could be a day where it absorbs some of the weekend news. The weekend news could be bearish news or bullish news. But there are some other ways we'll look into today to find, again, always follow the money. Are investors bullish or are they bearish? So, but we'll get to that here in just a little bit. But let's get into Tuesday. So we have the Jerome Powell, who's the federal chair speaker, who will be speaking. This could easily provide a massive amount of volatility, because he could say anything. He could say something that could encourage investors to buy, or he could scare investors to sell. So he could say, one of two things. He could say, something about, cooling down interest rate hikes or something, and so that may give investors a little more hope for the near future. So that way, because once investors start seeing that they're going to stop interest rate hikes, investors are going to be, like I said, they're going to start seeing the light at the end of the tunnel, because eventually they're going to start doing what's called interest rate easing. So that means they're going to start lowering interest rates, though that could be most likely something either towards the end of this year or the beginning of next year. As well as the quantitative tightening, or QT, which is something that we like to talk about every once in a while, which is when the government is selling billions of dollars worth of stocks. That is also something that starts to cool down a little bit towards the summertime. So just know that the summertime is the beginning of our bull season, and most likely our bull market. So it's going to be very intense. But just know that this is a 50-50. It could go either way, and most likely when we look into Monday's activity for options activity, most likely we're probably going to see a lot of a 50-50 call and put ratio. So the other thing that's important to know is knowing when this is going to be released or started. And so when we're looking at this on the website, it's always going to default it to the Eastern time zone. So depending on where your time zone is, you may have to readjust, or you can always click on the little icon here and change it to your time zone. But if you're looking at it on the application, it'll automatically adjust it to your time zone. So that way you know exactly what time it will be released. And so, and again, it's just important to know exactly what time the market, begins and closes. But by looking at this, we see that the Jerome Powell will be speaking 30 minutes before the stock market opens. That means that this is telling us be prepared for massive volatility during pre-market. Now, for those that for us that like to straddle, it's not always a good thing to straddle into a day that is not scheduled to have activity, because when it comes to straddling both calls and puts, we need to go into a day with a massive amount of volatility, because more volatility the better. It does not matter if the stock market surges straight up to the moon or plunges to its death to the bottom. And so as long as it picks a direction, it's going to be profitable either way. And so, but this is a great day to straddle into, because we have volatility first thing in the morning, and then shortly after that, then we have the EIA short-term energy outlook, and so that's not going to provide as much volatility as the Powell speaker. And so, but it still may provide more momentum a few hours after the stock market opens. So we'll see. Hopefully that just continues the same characteristic. Going into Wednesday, then we have the crude oil inventory reports that's scheduled to be released 1 hour after the stock market opens. And it's interesting how these are timed, because the first hour and the last hour of the stock market is the most active times of the day, and so usually we'll see the economic reports sometime early in the morning, creating a massive amount of volatility, and then usually towards the end of the day we have like press conferences, or Biden will have a speech during power hour. So that's their way of creating more volatility during power hour. So we got early in the morning for this, and then we have other sources for more volatility. And so it's just a way to make a bearish day more bearish, or a bullish day more bullish. It's like pouring fuel on the fire. They do this intentionally, so that's why it's highly critical that we master this stuff. And so, but if you don't know what any of this stuff is, you can click on it, and it will tell you exactly what it is. And right here with the first paragraph, and whether you're on the application or the website, it'll tell you what it is right there and how it will affect the stock market. And so, but a lot of these are pretty repetitive, like the unemployment report and the crude oil inventory reports are weekly reports. But we do have monthly reports, quarterly reports, and yearly reports. Now, the more rare the report is, the more volatile it's going to provide the stock market. Now, it's highly critical that we also focus on the forecast versus the previous, because this is critical, you guys. This tells us whether that day is going to be bullish or if it's going to be bearish. Now, sometimes we don't see a forecast just yet because they're working on it, but sometimes we can kind of figure it out. So we'll have to take a look at what the previous report was. So usually the oil inventory levels fluctuate. 1 week they're high, 1 week they're low, but most reports, they need to be high. And so, but there's two reports that need to be low, and that's unemployment report and the crude oil inventory levels. And the reason why that is because if the unemployment report is low, that means people are working. People are working. They're paying taxes. They're shopping, and that helps the economy. Even though the government's trying to crash the economy, it's not completely working. But the crude oil inventory levels is kind of the same thing, where they need people driving. If they're driving, they're spending fuel. They're flying. They're going on vacations. They're spending money. That helps the economy. And so last week the crude oil inventories was up, which is bearish. They need to be down for it to be bullish. So that means that this week they'll be down, which will be bullish. So keep in mind too, with the quantitative tightening, which is what we were talking about, quantitative tightening has pretty much, which has started last August or September, has been twice a week on a Tuesday and a Thursday. Though the government's been very tricky about it. Unlike when Donald Trump was president, when we had quantitative easing, it was consistently early in the morning. So it was something that we can expect. And he did it to help us because it was consistent. We knew exactly when it was going to be executed. It just made it easy. The quantitative tightening, they can execute this selling activity during pre-market. They can execute it during the middle of the day, or they can even do it in the last second during after hours, making it look like that quantitative tightening was never executed. However, when they do it during after hours, even at the last second, it makes it look like it was never executed at all. But what it does, it affects the next trading day, but it also softens the blow. So that way it's not that severe, because when you do it during after hours, it's just, it gives a lot of investors a lot more time to to think, or to process. Or a lot of investors can't even trade during the pre-market. So that's why I'm saying that the bearish characteristics that quantitative tightening can provide can be softened up when they do that. And so but like I said, there's those three scenarios. We have it where they can do it during a pre-market, which really affects the pre-market, and when the market opens, that's when we just see the stock market just plunge. When they do it during the middle of the day, that's when we see that massive drop. It makes it very, very obvious when they do execute quantitative tightening. And so, but like I said, then we have it during after hours. So if they haven't done it at all throughout the day, and we're in power hour, then we know they're going to execute it during after hours, and that's when we'll see that call and put ratio, where the put ratio will be pretty heavy. And so but like I said, it's just really, really important to know that. So if looking at the schedule here, so if Tuesday, let's say they do execute quantitative tightening during, whether it be pre-market or during the middle of the day, and so if crude oil inventories looks like it's going to be bullish, Wednesday could be a good green day, and so, or a recovery day, and so but yeah, so Tuesday I would say looks bearish, Wednesday looks bullish, and then let's take a look at Thursday. And again, it's really important to kind of focus on the forecast versus the previous, because again, this tells us and investors in Wall Street whether that day is going to be bullish or bearish. Though there could be some mixed signals, probably not much, but we can see that the core CPI month over month for the month of December is right here. We also have the regular CPI, and then again we have that very rare one, the year over year CPI report. And so we see that the core CPI is forecast to be a little bit higher than the previous, so that is that would be bullish. And so unless the government is trying to crash the economy, then their investors are probably looking for maybe smaller numbers. And so, but we do kind of see that the CPI month over month for December is about the same, and so 0.1% versus 0.1%, though the year over year CPI is expected to be much lower than the previous. And so we have a 6.5. So usually it as long as it's less than the previous, it should provide bearish characteristics. But if investors and people at Wall Street are hoping that it goes down, sometimes that could provide bullish characteristics. Now that's rare that the opposite can happen, but it does happen if like I said, if Wall Street and investors are anticipating that the numbers are down. Like I said, sometimes that can provide the opposite effect, but normally, and that's why we always want to go with the majority. So the majority of this would, and we have the unemployment report, which is higher than the previous, which would also be bearish. So we have, I would say, two bearish economic reports here. We have one that is kind of to be determined, and then one bullish report. So I would say the two bearish characteristics will outweigh the others, especially the rarest report here, the yearly report, should dominate all of them. And so this should provide bearish characteristics on top of the quantitative tightening. So and then going into Friday, it could be the same type of effect that we had last Friday, just the other day, where the morning opened up in the red, and then it started to kind of mellow out a little bit, and then it closed in the green. And so let's see, because I think the next following week is a holiday, which that's the Martin Luther King Jr. Day. So just know that the week after this week, it will be a 3-day weekend. So Monday is closed, and then we'll have more reports on Wednesday, Thursday, and a Friday. So Tuesdays, they're going to try to make Tuesday react like a Monday, kind of a recovery day, or a day that can absorb the weekend news. And so, but usually holiday weeks are filled with low volume. There's just not a whole lot of activity, but to be determined. It looks like there are some still pretty good major economic reports, but we can always dive into that later. But yeah, so just know, this week looks like it's definitely filled with a massive amount of volatility, and all of these 4 reports for Thursday is all scheduled to be released 1 hour before the stock market opens, which is another great day for straddling. And because there's going to be, I mean, the stock market, it could be up or down several percentages. And so just to be determined, we always want to protect ourselves from manipulation. So as a reminder, with the quantitative tightening, let's take a look at that really quick. This is something that we can always find on the Federal Reserve Bank of New York, since that's the bank that the government likes to use for their accounts. And so, but they don't like to let the public know what they're doing. Whether they're buying stocks or selling stocks, but they do have to let the public know. They just don't have to repeat it or anything. The media doesn't talk about it. When they do quantitative tightening, when they sell billions of dollars worth of stocks and they crash the stock market, they blame something else. Whatever the news, it could be Elon Musk, it could be North Korea firing missiles, Putin, blah, I mean, so on. They'll just pick some, something random or whatever that looked good for the day, and they'll just, blame it on that. But you won't hear the news media or the government say, oh, the stock market crashed today because we sold $16 billion worth of stocks. They're not, so that's why it is up to us to know exactly what's going on and to know what's going to happen before it happens. So for this week, we have for Tuesday the 10th and when we have the Thursday the 12th, we can see that the Tuesday the 10th, that the government is scheduled to sell $3.3 billion worth of stocks. And then Thursday the 12th, they're scheduled to sell $11.5 billion worth of stocks. So that's just trimming the fat right off the market. And so that can create a chain reaction of other investors to also sell billions of dollars worth of stocks. So that, like I said, it's just really, really important to always know what's going to happen before it happens. And so, but looking at the future here, we can see that they're selling twice a week up until right around May. So we have, let's see, yeah, right when we get into May. So we have May 2nd, May 4th. I think that is basically the last time we're going to see quantitative tightening twice a week. Then it goes May 11th, May 18th, May 25th, June 1st, June 8th. So they do it once a week up until we get to the summertime. Then it's once every couple weeks, and it's once a month up until towards the end of the year. So that's when, again, the government or the investors will begin to see the light at the end of the tunnel as we get closer to the summertime. That is our bull season. That is time to rock and roll. And Wall Street and the investors, and they're going to try to recover stocks so fast and so quickly to the point where these stocks are going to recover very, very quick. And Wall Street investors and possibly the government may start quantitative easing, but with the looks of this, I would say they're going to probably start doing quantitative easing next year. So they're probably going to start buying stocks, but to be determined. This is the schedule. Looks like it goes towards the end of this year, but it's still very, very important to know. And they could change. They could change, maybe something here. They could always change something in the economic reports. That's why it's always important to look at this stuff every week, but also every day. And so hopefully this makes sense. If anybody has any questions, feel free to unmute your mic. You can always talk or bring something to the table. It's up to you. But we also mentioned the press conferences and the president's schedule. On top of this, because the White House and the president's schedule, unfortunately, it's not really released, like a week in advance. But because their schedules are so crazy, that they are released the day before, and that's why it's important that we always look at the White House and the president's schedule. And this gets updated every midnight on Eastern time, or if you're on the Pacific time, it would be updated at 9 p.m. And so that kind of gives some of those on the West Coast an advantage, because they may be more awake, where they can kind of look into this and see what the schedule is like. And so like if we went to, there wasn't really, so if there isn't anything, like if we're looking on let's say last Friday, we can see that, because most of the time, if they're going to say something, they're going to say something either in the middle of the day or during power hour. That way they can provide volatility for the stock market. But we can see, like for Friday, there wasn't anything scheduled, to happen, and that's why one of the reasons why Friday was so bullish before close is because these guys weren't scheduled to mess it up, and because the investors, the stock market does not like our current government. They don't like our current administration. They don't like Biden. They don't like any of those guys, because those guys don't believe in the stock market. They don't believe in helping out the economy. So the investors in Wall Street, they don't like them. And if they say something, a lot of times they say something that investors don't want to hear. And so if they're usually scheduled to say something, we always usually anticipate bearish characteristics. If they're not scheduled to say anything, then we can anticipate some bullish characteristics. So that is one way to kind of look at it. Now, sometimes if they do have something where President delivers remarks on the border security enforcements, blah blah blah, sometimes it could be a subject that will help the economy, or maybe they'll talk about the automotive industry. They could mention companies at that point, like Ford Motor Company, General Motors. If they start mentioning companies, that's one of the important things to listen for, especially live, because when they start mentioning company names, the investors in Wall Street will start investing into them instantly. So if they start, like, for example, they mention Ford Motor Company is building a new factory, they're going to hire 4,000 new jobs after, they lay off jobs. But that creates a reaction in Wall Street saying, buy, oh, we got to buy. He just mentioned Ford, buy, and so all of a sudden Ford stock starts to go up, not instantly. And one of the reasons why it's important to watch this stuff live, or to monitor the economic reports as soon as they happen, is because the stock market will then begin to react as soon as it's released, versus being at the mercy of a news application. They're basically doing the exact same thing. They're waiting for these reports to come out, and then they'll create an article or an alert, and then they blast it out there. Well, by the time you get it, it's too late. And it could have been 5 minutes, or it could have been an hour later after the report has been out, or after the president or the press conference have delivered their messages. And so when we could have known what time that these events were going to take place, we can figure out whether it would provide bullish characteristics or bearish characteristics just from this, from all of this information. So, I mean, this is just just critical to know and to master and to utilize, because it's just going to benefit you. And so, but it's also important to look at stock options activity. And if you're new to stock options, as some of you may be, options help provide us information of what's going on. Again, always follow the money. It helps us to determine whether people are bullish or bearish. But also, we can see, utilizing the bar chart website, the most active stock options for Friday. Now, this information does update every 15 minutes when the stock market is open. So we can kind of use this as what I call our radar, because this is like our radar. We can see what's going on in the stock options world based off of options volume. Now, volume is always the current day's buying and selling activity, but we have a nice area for call and put ratios. That way we can see, are they more bearish or are they more bullish? Because not all are we, unlike like social media and other things where we can get people's opinions, But again, we can see where they're putting their money. But we can see that Tesla has dominated the list by a significant amount. 5 million in options volume. That is extremely rare. But Tesla's just been very, very volatile. It's been a very favorable one to day trade as well as to straddle. We can see that their call and put ratio is nearly 50-50, because we can see that investors are not sure what Monday's going to be like, but Monday could easily be very volatile because we see a lot of volume here. If they don't anticipate that Monday is going to be volatile, then the volume would be very, very low. But we can see that they're just not sure exactly if Monday's going to be bearish or bullish. But they're not taking any chances. They're going pretty heavily on Tesla because Tesla's pretty volatile lately, and but they're going 50-50. And as part of our guidelines for straddling, one of our rules is to always straddle, but always to buy our calls and puts at least within the last 15 minutes before close. And so, and the reason why that is because that way we're avoiding, because the middle of the day can usually be flat. If you start buying in the middle of the day or in the morning, and all of a sudden the day is it's not moving as much anymore, you're going to suffer from time depreciation. And we don't want that. We want to be able to buy, with the last 15 minutes going into the next day, with 0%. So we're not really, both our calls and puts haven't depreciated, and if the stock market did move in either direction, it's going to be a wash unless it moved significantly. But you may have a small gain on one side and a small loss on the other side, but it should put you at a wash going into the next day, where it's going to be significantly volatile. If you're not utilizing advanced graphs and charts, we can sell at the same time, but usually we'll want to do that after the first hour. Anything after the first hour, you'll begin to suffer time depreciation. But usually after the first hour, the stocks have already reached wherever that they're going to be. They could move, they could continue a little bit more, but to be determined based on your graphs and what you're trying to do. But we can also sell our calls and puts in the morning separately. We don't have to sell them at the same time. If we are utilizing moving averages with our graphs, we can sell at different times to maximize our gains and minimizes our losses. And sometimes we can turn that loss into a gain. Like last Friday, Tesla had opened it in the red, so we could easily sell our puts and secure our gains there, hold our calls, that way we can minimize our loss. And then all of a sudden, Tesla opened, or it went up into the green. So then our calls would have been profitable, so we would have profited from both our puts and our calls on the same day. And that's the beauty of straddling, is because we can control these things, and it kind of feels like it's day trading, but it's not. This is considered a swing trade. So no matter how much you have in your account, you have unlimited swing trades. And so that's why we can secure our gains and calls the day before to sell the next day, and we repeat the process over and over and over again. And we always go with our top 3 most active stock options, and we can easily see that this is the most favorable stock options to day trade and to swing trade. It's our Apple, Amazon, and Tesla. Now, usually Apple's always been the number one. Tesla's always been second place, and then Amazon's been third place. But ever since they did their split, Amazon has been kind of gaining a little bit more investors. And so, but with Tesla going through so much drama right now, it's just been a lot more volatile than Apple or Amazon. Because like I said, if Amazon or if Tesla, which was, it had opened pretty low last Friday, and now it closed 2.5, that could be like a 5-6% swing from one end to the other. And so that's huge. And so if you start getting into something else with lower activity options volume and open interest, you're going to have more time depreciation. And so that's why I consider anything that's not within the top 3 is a lottery play, because now you're going out of bounds. You're going out of the guidelines that help keep our consistent gains. You know, if you start going out and breaking the rules and stuff, you know, you're risking losing your gains. And so we don't want that. We want consistency, and we want to always go with the majority, just like the other pro traders. And so that's Tesla, Apple, and Amazon. But again, this is our radar. Sometimes we can see things that are not normally on here. If we want to venture into something different, like Bed Bath & Beyond's not normally on here. Laser or Luminar Technologies, they're not normally on here. Freeport, they're not normally on here, but you know, they're kind of on the bottom of the list. It's always important to focus on the majority of what's going on here. Now, there are some other areas to this. We can always click on the ETFs if you wanted to see what's going on with SPY, though SPY is more for day traders, not so much swing traders. And so we do have a significant amount of options volume with SPY, but SPY has 3 expiration dates on every Monday, Wednesday, and a Friday. And so, but just know that this is not a good swing trading stock, because it has a lot of time depreciation, a lot of time decay. And so that time depreciation is our enemy. We want to stay away from that as much as possible. And so that's why we focus more on the stock options. But if you're doing day trading, then SPY, is a good one. You know, it doesn't move a whole lot, but when it does, it is pretty massive in the options world. And but like I said, most day traders that will day trade SPY, you can see that right here, and a lot of them have been pretty bearish lately. Now, there's another area to this website that you can go to, option volume leaders, and this will kind of tell us what individual calls and puts were pretty active last Friday. Though some of them are expired now, we can see a lot of zeros for the days until it expires. So that's why it's important to look for anything that has a number on it when we're doing our due diligence through the weekend. So like 14. So this means that it has a couple weeks until that this call expires, and this one is for I believe this is AT&T. We have a $19.53 share price, but we have an $18 call strike price. So it's already in the money. We have Verizon, which is already in the money, which is kind of interesting. All of a sudden we started seeing a lot of cellular wireless companies that started having some activity in the stock options information here during the power hour last Friday. Uber, which we have a $23 put, it's currently at $26. So we have investors that are betting against Uber for the next couple weeks. They probably have earnings coming up soon, I would imagine. Then we have Tesla. Looks like this, out of everything that's currently active, we have the Tesla $100 put, and then we have a $120 call. So we have something right in the middle here. And though the put seems to be more dominant, we have about 86,000 in volume, versus the call has just under 70,000. So it looks like, I think, more investors are bearish for Tesla going into Monday. But we do see some straddling. They're probably more, and when we're straddling, we can go a little more heavier on one side over the other. Like for example, if we were to do this, maybe a lot of investors are probably more 60% puts on Tesla, maybe 40% calls on Tesla. And a way that you can do that, for example, is, let's say you can get maybe 6 puts of Tesla and 4 calls of Tesla, or you cut that in half. Then you can do 3 puts of Tesla and 2 calls of Tesla, and that's where you can get that 60-40 ratio. Trying to be a little more heavier on one side over the other. you know, usually I'll try to look at the overall calls and put ratio to help determine you know, what the rest of the investors are doing. And so that's a good way for that. But it's still good to have a limit. Like if it was like 60 or 70-30, you know, that's a little too much. I mean, what if the next day is heavily manipulated, which it can be. I mean, it easily could, and it happens. And so that's why we want to make sure we have a certain limit. And my limit's really not to go over 60-40, because manipulation can happen at any time, no matter what is scheduled to happen. And so, and that just happened, not last week, but the week before, with quantitative tightening and Tesla. Elon Musk mentioned on a day that was supposed to be extremely bearish, Tesla Elon all of a sudden tweets that Tesla will eventually be the most valuable company on the planet. And everybody, that triggered the investors like, oh, buy. And oh man, that just turned a bearish day into a very bullish day. And just from a tweet. And so, but like I said, that can happen to anybody, you know, any tweet or any politician or whatever. And so, but like I said, it is rare. And that's why we always want to focus on the majority. Now, we can sort this page out by open interest, but it does default it to volume, which again, volume is always the current day's buying and selling activity. But if we click on open interest, then we want to click refresh just to refresh the whole page by open interest. Now we can see how completely different it looks, because open interest is an accumulation. Open interest, if you don't know what that means, it basically says the total number of open contracts that have been traded but not yet liquidated via offsetting trades. That means investors have bought these calls and puts, and they are still holding on to these calls and puts. They have not sold them yet. And so, again, this is another way to always follow the money. What are investors doing? Where are they putting their money in? Millions, if not billions of dollars worth of money. And we see that Starbucks is the number one with the highest open interest. And they had a lot of volume last Friday, probably most likely accumulating more open interest, because we see that Starbucks right now is right around $106 a share, but we have a $105 call, so now it's already in the money. But next one is a $115 call strike price that expires next March the 17th, so approximately 69 days from now. It's around $224 a contract. And so so we'll have to kind of monitor Starbucks going into tomorrow stock market. Though we'll have to take a look at maybe some other things. Why are investors bullish for Starbucks? So we'll have to kind of look to see if there's any company events that's going on. Maybe financial earnings reports are pretty soon. So we'll have to figure out why. Because sometimes there's inside information. Sometimes investors know what's going to happen, and the news media or nobody really knows what's going on. There could be inside information going on that nobody knows yet. So this is our radar. Remember, we see everything that's going on, and so that's why we want to always utilize these free tools. And so we have AMC. A $6 put strike price, which is already in the money. And so then we have Ford Motor Company, $12 put, but we do have a $12 call right down here for Ford Motor Company. PBR, but sometimes we can see or find figures that are significantly different from each other, but I don't see anything yet. But because we're in the middle of our in actuality, we just entered our bear market. The bear season is the first quarter. It's the winter season. The springtime is a transitional season. It is the transition between the bear season going into the bull season. Once we get to the summer season, or the third quarter. That is our full-on bull mode, our bull season, and our bull market. And so this will look way different, because right now, it just seems like a lot of people are probably selling, getting rid of what they were holding. We're not really seeing a whole lot but maybe they're slowly accumulating right at the money, which is one of our rules when it comes to straddling or much of with options, is to when it comes to the strike price, because we hear that a lot. What strike price should I pick? Well, with one of our rules and guidelines, the strike price should always be the same price as the share price. So that should always immediately answer that question. What price? What strike price should I pick? Well, sometimes if it's right in the middle, then you can always pick, the one in the money, versus the one that's out of the money will be the one that will depreciate, because it's out of the money. If it's within the money, it's going to have the least amount of time depreciation, because it's within the money. And so but yeah, so this is just really, really important stuff. These three basically pages are the most important pages to really to look at. And so but there is a website we can go to through NASDAQ if we wanted to see like the most active individual calls and puts. Let's change it to Tesla here. We can always change the ticker in the URL address, making it really quick and easy. Once you have the NASDAQ link, we can always change that to get the most active individual calls and puts for a particular stock option. In this case, this is Tesla's information for last Friday. And again, this information I believe also updates every 15 minutes when the stock market is open. So we never have to wait a long period of time to get live results and information, to see what's going on, who's investing into where, and what's gained and what's lost. Other than that, the earnings is always something to kind of look at too. Now, earnings, it's not recommended to utilize options through earnings, because earnings can provide a massive amount of implied volatility, but it is considered what I would say as a lottery play. A lottery play is something where we can invest light into. If it doesn't work out, where it's money lost that we're not going to worry about. Just like if you're going to invest into the Mega Millions, whatever, we're going to try to get that. I don't know if anybody won or not, but if you're trying to get that, then $900 million lottery, you're going to invest some money into it, $5, $10, $20, $100, whatever. But it's money that you're just going to put into and hope you win big. But if it's a small amount of money that if you lose, it's money that you're not going to worry about. And so the lottery plays are basically the same thing, where if we know that there's going to be particular direction, we can always invest into it, or maybe there's a significant amount of volatility, we're just not exactly sure which direction, we can always straddle that as well. But this is our calendar, or basically our schedule for earnings for this week. So Tilray, which is going to be first thing tomorrow morning, that is going to provide a massive amount of volatility for the cannabis segment. And so Tilray is basically kind of one of their number one cannabis stock options. So this is kind of like the head one, and it'll definitely going to affect all the other ones, whether it be Kronos Group or Canopy Group or whatever, Aurora Cannabis. And so they're all just going to be extremely volatile tomorrow morning. hopefully they're bullish. And then tomorrow after close we have WD-40 and a few other ones. But the major ones are pretty much going to be on Thursday and Friday. So Thursday we have the Taiwan Semiconductor Company. Out of all microchip manufacturers, the Taiwan semiconductor company which is a company that the United States helped Taiwan establish, is the #1 producing manufacturer in the world. And so this is a major company. This is going to be a major report. All eyes are going to be on this semiconductor company. And so it's definitely very, very important to know kind of what's kind of going to go on there. But Friday, it kind of seems like, so Friday's kind of looking like it's really the beginning of our earnings season. Probably going into the next following week, we're going to have a lot more major companies, but that's why, there's just not a whole lot going on here. But again, the next following week is also holiday week, so we'll take a closer look at that. But Friday, we got Bank of America, we got the United Health Group, we got JP Morgan, then we also have Delta Airlines. So Delta Airlines will also affect other airline stocks. Now, if you want to avoid the IV crush or implied volatility crush, was options that will usually can get crushed from earnings. But a way to avoid IV crush is to maybe do a straddle their similar stocks. So, for example, Delta Airlines, you can always go with American Airlines. So American Airlines doesn't have the earnings, so they're not going to be affected by implied volatility crush. Or with the cannabis, the Tilray group, instead of maybe doing Tilray, you can do the Kronos group or the Canopy group. That will still be volatile because of these other earnings reports. And so that is a way to kind of kink the system a little bit with that type of strategy. But we definitely have a lot of bank stocks that are going to be released. Now there is I did post the monthly report, though we were still waiting for I think a few, but we're still waiting on the Apple, Microsoft, and AMD to schedule their earnings. But this is what we have so far for this month. And so going into the next following week, we can see that we have a few more banks on Tuesday with Goldman Sachs, and then Morgan Stanley. And then Wednesday we have the Charles Schwab and Discover. But Thursday, the 19th, that we got Netflix. And Netflix has always been a huge, major, volatile stock lately. And then Friday, it looks like we have Ally Financial, a couple other banks and stuff. But yeah, Tesla looks like, so Tesla's Wednesday the 25th, so that's going to be a massive amount of volatility with Tesla, but also the other EV stocks. So man, we got a pretty busy month ahead of us here. But we also post the top 10s analysis. I still have a few more that I got to do, but at least we have some of the top ones here, like Tilray is scheduled to release their earnings report tomorrow morning before the stock market opens. However, the company's earnings release has a 64% expecting an earnings beat. So that is, if you look at what's the opposite of that? So that means that Tilray has a 36% expecting an earnings miss. So it's always good to look at both sides of things to kind of help determine, what you want to do. Maybe you want to go, calls with this one, or maybe 60% calls, 40% puts, because option traders are pricing in around a 15% price movement in either direction. This is the biggest movement for this week is this cannabis stock. All the other ones don't seem like they're really anticipated to move a whole lot, but maybe 3, 4, 5%. Bank of America, which is confirmed to release their earnings on Friday morning. We were just talking about that on the schedule. However, the company's earnings release has a 56% expecting an earnings beat. Option traders are pricing around 4 to 5% price movement with Bank of America. Normally it doesn't move quite that much. Normally it moves 2 to 3%, but but we are expecting more movement with this one as the government has done more interest rate hikes. Now, this is very, very interesting. If you check out like your local credit unions rates for mortgages or auto loans, it's crazy high right now. We're at what, almost like 6.9% for an auto loan. A year ago, it was like 2.9% for an auto loan. But for some reason, like I just went on Bank of America's website, just yesterday, just checking out their interest rates, and with certain auto loan interest rates, they're at 5%. I'm like, whoa, what is going on here? Bank of America, they should be at like what, 7.9, 8.9% for an auto loan. Why are they beating credit unions? So I'm thinking, is this the plan? Is this the plan, the government's plan for major national banks to now outdo our local credit unions? This could be devastating for these credit unions, because now people are going to be focusing on these national banks for their auto loans rather than their local credit unions. I mean, 5%. I mean, that's a big difference between going 5% to 7% for an auto loan. And so, so this is, like I said, I'm just now starting to see this as we're starting to get more interest rate hikes. But this could provide these banks more business than they've ever had before. And so, but like I said, to be determined. We need to kind of really, focus on what's happening now and what could happen here in the near future. So just like I said, just food for thought, just something to kind of put out there. That way we can all monitor this together. United Healthcare, they are expected to release their earnings report Friday morning before the stock market opens. United Healthcare earnings release has a 56% expecting an earnings beat, while option traders are pricing in around a 3.5% price movement in either direction. JP Morgan, they are scheduled to release their earnings report on Friday morning as well. The company's earnings release has a 65% expecting an earnings beat, while option traders are pricing in around a 4% price movement, when normally it moves around 2 to 3%. Then we have the Delta Airlines. Like I said, this is a very, very important one to go over, because it's a volatile stock, especially during it's a very sensitive subject, because it helps provide economic news, and plus with airlines have been a mess during this whole winter storm. They had all these closures and whatnot. So but again, this financial earnings are based on the fourth quarter. The winter storm was during the first quarter, so that's why it's very, very important to really know what's going on. That way you're not getting things mixed up. So, but during the fourth quarter, there really wasn't any major storms that created a lot of cancellations. So I do know a lot of people were flying, and so this could be good for Delta Airlines as well as the rest of the airlines. But by looking at this, again, not only is Delta Airlines scheduled to be released Friday morning before the stock market opens, but the company's earnings release has a 70% expecting an earnings beats. That's pretty good. Normally average, for this stuff is right around 65%. 65. Any less than that is considered below average. Any more than 65% is above average. And so 70% is definitely above average, while option traders are pricing in around a 5% price movement in either direction. So, but it definitely looks bullish. And as a lottery play, you can just throw calls at it. You don't have to do puts or anything, because 70%, again, we're above average. Just go light. We can put some calls on there, and if it works out, we could gain 20%, 30%, 50%. Maybe even more, and so then we have the commercial metals company. Metals, and we can see with the pictures and stuff, they deal with a lot of metals. So we are still going through a shortage on metal materials, and so we just don't have as much as we used to, and so Commercial Metals Company, or CMC, is scheduled to release their earnings report on Monday morning before the stock market opens. The company earnings release has a 47% expecting an earnings beat, which is way below average. Option traders are pricing in around 11% price movement in either direction. Now, one of the reasons why we have a shortage in metal material is it's interesting, as the longer we're trading, the more that we remember a lot of these economic events. And so when Donald Trump was president, it's funny because as a Republican president, you do things differently to manipulate the stock market. His way to manipulate the stock market was like, trade wars. It was kind of like picking on China, versus other like democratic leaders and governments and presidents and stuff. They usually use fear. They sell fear to manipulate the stock market. And the fear, I mean, it could cost lives. It could, like the financial collapse, foreclosures, the Twin Towers getting hit, so on and so on. This is devastating stuff. Donald Trump, he basically was picking on China, with the whole, like the tariff wars, the trade wars, things like that. But it all started with the trying to implement, more regulations with China. So, for example, when the Chinese stocks have their financial earnings, which is exactly what we're talking about now, their quarterly financial reports, for like companies like Alibaba or Neo, when they disclose how well they did last quarter, they're not audited. Meaning, when they say this is how well we did last quarter, we just have to take their word for it. Unlike any other company that's part of the stock market, it's audited by a third-party company. So that way, when the company says this is how well we did or how bad we did last quarter, that it's been proven by the third-party auditor company, saying, okay, yeah, they're telling the truth. But with the Chinese companies, they don't allow anybody to audit their numbers, because they believe that when they do, that they're just going to spy on them, and China doesn't want spies in their country or whatever. And so we have to rely on their word. And so Donald Trump didn't want that. He wanted everything to be fair, because the rest of the world's stocks are audited except for China. So that's not fair. So he said, okay, China, you need to catch up with the times and participate with the rest of the world, and we need to implement these audits. And they're like, no. And so Donald Trump was like, okay, then if you're not going to participate, we're going to start doing these tariff wars. We're going to start increasing, these trade, tariffs to 5%, 10%. And then so it would cause Chinese stocks to start to plunge. That was kind of the first phase to try to, to persuade China to participate with the rest of the world. And so, but they would not budge. So finally, towards the end, this was like during 2019, Donald Trump threatened China by saying, if you don't participate, then we may delist your stocks from the U.S. stock market. So if we would have delisted Neo, Alibaba, and all these other Chinese stocks, that would have cost China billions and billions of dollars worth of revenue. And that pissed off China. China basically said, fuck you, we're no longer going to mine these metal materials for you guys. China produces almost 50% of the world's supply in metal materials, and they cut us off. That is where the shortage started. Our government or whatever, they'll create excuses for things. They'll say, oh no, it's not because of that. It's because we shut down the factories for 3 months during the second quarter of 2020. No, that's not. That may be part of it, but the main reason is because of this. We lost our source. We had to immediately open up brand new mines in Australia and other areas that we were kind of reserving for this type of situation. So now we can mine within our own type of territories that I call the British colonies, areas where the British had kind of dominated, like the United States, South Africa, Australia, those type of areas where we can kind of mine those areas for our own cells, for our stuff. And so, as well as rare earth materials for our microchips. China's like, if you're not going to provide us, microchips, we're not going to provide you the rare earth materials. So it just became a huge, global mess. But that was the history. That is what we went through, day after day, watching this drama unfold. And so, but if these companies like Commercial Metals Company can't get these metal materials, they can't manufacture things, and that is what ruins their growth and their revenue. And that is the reason why the company's earnings release has a 47% expecting an earnings beat, because they just can't get enough materials. I mean, we have a shortage in vehicles and all kinds of stuff that you would think that these companies would be, extremely busy and have huge growth. But not only are they a shortage in metal materials, but there's still a shortage in staff, which is crazy, because unemployment is extremely low, and it's been reported lately right around 200,000 people per week filing for unemployment. Before the pandemic, people were filing, there was like 300,000 people filing for unemployment. We're so low when it comes to unemployment that it basically means we have a population shortage. We have a population problem, and occasionally the government will mention it, but not very often, because they don't want you to put two and two together, meaning that's the reason why the borders are completely wide open. The borders are open. They're like, come on in, because, we just need more people, we need for more jobs, but, it could be for other reasons. They may need it for more Democratic voters, whatever that it is. But ultimately, we have a population problem. People aren't having as many kids like they used to, like the baby boomers, where the government incentivized people to have kids. So they're just opening the borders, come on in. We're seeing more and more people from Ukraine coming over. They're getting a 2-year pass to be here, which could possibly be extended. Other things could happen that could also allow them to be here longer or permanently. And so, but like I said, there's just a lot of things going on that will help increase the population, so that way we're not having such a population shortage. But it does look bad here for the short period of time, as well as the long period of time. But a lot of companies, like, again, they're having a staff shortage problem, and which could be part of the problem. So. Does anybody have any questions? Anybody want to go over anything at all, or anybody want to bring anything to the table? Everything makes sense so far? Everybody ready to rock and roll?
Carlos, I have a question.
Sure.
The question is, the volatility, we have some trapped. My question is, how do I play the stock market just move sideways?
So the stock market's like, if it's moving sideways, like not at all, or it's just constantly moving up and down, but it's moving, but it's not really going anywhere.
Yeah, actually, it's not moving anywhere. Just let's say average is like 64.5, 64.3, something like that. This range is never up. For this reason, spread is always moving money. So.
And that's why, it's important to know what's going to happen before it happens. So going into a day when there's nothing scheduled to happen, that would not be a wise idea to really straddle into. However, it is extremely important to straddle into a day that is scheduled of activity, events that are going to create volatility, especially during pre-market. We want those economic reports early in the morning, whether it's 30 minutes before the market opens or 1 hour before the stock market opens, because when the stock market opens, either side, your calls or puts are going to be substantial. You could only lose what you have on one side, but your gains on the other side are potentially unlimited. Meaning where you can lose 100% on one side, but your gains can be 200%, 500%, or even over 1,000% on one side, which can wash out your loss on the other side. But for going into a day when there's nothing going to happen and it's flat, that's why it's really, really important to completely get out of your positions during that first hour. So if nothing's going to happen, and you're either going to be at a wash, or you may be at a slight loss. You may be at a 5% loss, 10% loss. It's better just to get out within that first hour at a small loss or a wash, rather than holding throughout the entire day, suffering from time depreciation. Because at the end of the day, you could be at a 10% loss, 15% loss, or a 20% loss just because you held, because you were hoping that it would turn around. And that's one of the important things that we need to avoid, is utilizing the hope system. We want to ensure that we're always using a process, and I'm going to try to upload it really quick. That way I can kind of go over it with you. Our rules and guidelines. Give me a moment here while I do that for you here. Upload it to one of our chat rooms, because I want to make sure that our rules and guidelines completely make sense. And change a few things, add a few things here. So yeah, that, and then I want to talk about the differences between an amateur trader and a professional trader. So let's go there. Okay, so where did I upload it here? Okay, so our rules and guidelines. So rule number 1, it says always straddle heavy on the top 3 stock options. And again, that is pretty much always Apple, Amazon, and Tesla. Now there will be a time, where a new stock will take its place, because maybe one of these companies may file bankruptcy, or something will happen. It's just like an athlete or a boxer or whatever. You always have like a number one guy, but eventually someone is going to take its place, and there'll be a new guy that'll be the number one. But for right now, it's Apple, it's Tesla, and Amazon are the top 3 according to the most active stock options. So that answers that question. What are the top 3 stock options? Boom, right here is where we can find that information, and so that way it always helps answer that question. Rule number 2, strike price should always be at the share price, which we talked about. If you're out of the money, then you could easily suffer time depreciation, especially if you're going into a day that's flat. You're really going to suffer time depreciation because you're out of the money. The system may think that it's never going to reach it, and that's why it's going to suffer more depreciation, and we don't want that. We want to be right at the money. If it's not affordable, then find something that is affordable. Another stock option. If you're trading Tesla and it's too much, and you want to go out, no, don't do it. Stay with something that's within the money, and go with Amazon or Apple if it's more affordable. And so, rule number 3, it says always the soonest expiration date. Because a lot of times people ask, what expiration should I do? Should I do next week or the week after? No. We want the soonest expiration date for the most volatility. We want that high volatility. We want to gain 200 or 400% or 1,000% on one side, while we're losing maybe 100% on the other side. We want that huge percentage swing. If we start picking expiration dates weeks in advance, we're not going to see that volatility, and you're going to be paying a lot more for those premiums. And so, but ultimately, we want the volatility, and that's why rule number 3 says always the soonest expiration date for the most volatility. Now, rule number 4, it says buy our straddles 15 minutes before close to sell the next morning within the first hour. Now, when I created this guidelines, it was the first 5 minutes, but I started to notice that a lot of you needed more time to process your order, your settings, because a lot of times I see people that they were struggle the first 5 minutes. They secured their calls, but their puts didn't go through. So obviously you need more time until you can really dial down your application. It's one of the reasons why I use the Robinhood app to do my swing trades and day trades, is because the processing the orders are so simple and require the least amount of input. So that way you can just type in what you need, blast it out there, and get it to execute. If you start using other advanced programs like Webull or other things, it just takes a little bit more time to process that. And however, the share prices, they're not waiting for you. The prices are still moving up or down, and so by the time you get your settings in there and send it out, the price may have already passed your limit price, and now the order isn't going to execute. So then you got to go back in there, modify it, readjust it, or cancel it and start over. And so this is why you may need more time, but you should be able to get it down with no more than 15 minutes before close. And so that's why I changed rule number 4 to buy your straddles within the last 15 minutes before close to sell within the next trading day within the first hour. Yeah, if nothing happens within the first hour, get rid of it. Even if the day is flat, it's like avoiding a fight so you can live to fight another day. That way you can trade another day. Forget it. Just we'll trade on a day that has more volatility. And so just don't let your emotions affect your buying and selling decisions. Think process oriented, which is what we're going to look at next. So rule number 5 says avoid earnings and splits when it comes to like straddling and things like that, or going heavy on, because of the implied volatility crush. And one reason why that can happen is, let's say we're anticipating big movements for a particular stock option, but all of a sudden some weird news happens and it doesn't move at all. Maybe the stock moves, a 0.25% or a 0.5%, but we were hoping for 5% or a 10% movement, but it doesn't move at all. And so what happens is the implied volatility gets crushed. Both sides, both your calls and puts could get crushed 20% or even 50%. I mean, that completely is discouraging. If you lose 50% on both your calls and puts, I mean, it's and that could have been avoided by implementing these rules and guidelines, by avoiding earnings and splits. But if we're more certain that that the earnings will be bullish or bearish, again, as a lottery play, we go light. Light meaning you can do maybe $50, $100, $1,000. It just depends on your what is light to you. That way you're just not doing like tens of thousands of dollars or hundred thousands of dollars during an earnings play. You definitely do not want to do that. But straddling, you can easily put $100,000 straddling into Apple, Tesla, or Amazon. And I mean, I do it all the time, and it is very, very beneficial. You can easily turn that $100,000 into another $100,000. And so that's why we always go heavy on the top 3 stock options. So rule number 6, avoid straddling throughout the middle of the day, minimizing our time depreciation. Because like I said, after the first hour, once the prices get to a certain point, they usually like to stay around there, unless we know that there are other events that are scheduled to happen, like Jerome Powell. Sometimes he'll speak in the middle of the day, or Biden, or the White House press conferences. But if we know that there's nothing going to be scheduled to happen, then avoid the rest of the middle, because the middle of the day is what I call day trading territory. That's where we're getting a nice mellow amount of movements. They're more predictable using our moving averages, so we can get in, we can get out, secure our gains, and then after the last 15 minutes, we go heavy on our straddling. So it's a process that we repeat over and over again on a daily basis. There's no reason why to try to fix something that's not broken. This is an amazing and a lot of this is too basic for a lot of people. A lot of people think they know better, but once I had a great friend tell me this a long time ago. He said once an investor believes they have the stock market figured out, that is when the stock market has the investor figured out. The only way to get around that is by straddling on a daily basis, utilizing these set of rules. And straddling was introduced to me a long time ago. When I created this group about 5 years ago, it's neat because we offer a lot of different benefits and features and advantages and whatnot, and it helps attract other professional traders and investors that specialize in something different. And when I had learned that these highly successful, very wealthy investors and traders, that's all they do. They said that that's all I do. I just straddle SPY or Apple or whatever. And one day I decided let's give that a try, and it's just very easy. It was very basic, but it worked as long as you're consistently at it. And so, but I do want to go over the differences between an amateur trader and a professional trader with you, because it's so important, because this is kind of like knowing the difference between right and wrong when it comes to trading. You don't know the difference between what's right and wrong unless someone tells you it, or unless you're just figuring it out the hard way. But an amateur trader will often let losers run and hope that it turns around. And there's that word hope. We don't use the hope system because we always got to know what's going to happen before it happens. We're more based on certainty, not hope. Professional traders let losers, or will cut losers when stop is reached, like a stop loss is reached, or a trade idea is invalid. For example, we were talking about the first hour. If there's no volatility within the first hour, the trade idea is invalid and it's time to abort, and then we'll redo it again. We'll buy our straddles 15 minutes before close, and we'll redo the process, because it does consistently work a majority of the time. But if you are going into a day where there's nothing happening, then it's a slight risk, but it's still maneuverable. You can still we can still sell at different times, so we can maximize our gains on one side and minimizes our loss on the other side, especially in the first 15 minutes of the market opening, because we see these big swings. When the market opens, we see this big drop. Then after 10-15 minutes, the market wants to try to recover a little bit before it continues to recover for the rest of the day or drops again. So this is where we can try to benefit from a day that's going to be flat. So that way we can take advantage of that first 15 minutes. Amateur traders will close winners too early because of fear of giving back profits. Maybe they just got beat up a lot on a lot of these bearish days, and now we got a good green day, and now everyone's like, oh, I should have held my calls, blah, blah, blah. Well, they should have used moving averages. Moving averages is what helps us provide us these buying and selling signals of when to buy and when to sell, based off these crossover signals with the moving averages in the MACD. So if it's saying to hold, not to sell your calls, and to be determined, it basically said to sell your calls at the end of the day. Apple pretty much came up. It dipped down, but it didn't have a final sell signal. But it would have been a great area to sell our puts, and then as it went up and continued to go up, we could have sold our calls towards the end of the day and secured our profit, or maybe within the first hour or a couple hours, whatever. But this is really, really important information that provides us our intelligent buying and selling signals, and so that's part of our way to of a system that can provide that. So where professional traders will let winners run until profit order or when a clear signs are given to exit. Trust their system. We gotta have a system, and if you don't have a system, if you're just using just a basic, Robinhood graphs, which is really their 5-minute chart with just a one line, that's not giving you clear signs when to buy and when to sell when it comes to day trading or getting rid of your straddling. Otherwise, you're probably just going to be at the mercy of selling your straddles at the same time if you're using a basic graph. So, but it is a good idea to start practicing moving averages if you haven't already. And when I had discovered moving averages a long time ago, I did not really want to practice buying and selling these signals when the market was open, because to me it was like the Super Bowl. It's not a time you got to practice. You should practice way before the Super Bowl. But how do you practice moving averages when the stock market isn't open? And so one day I was like, aha, I decided to trade cryptocurrency. So like Bitcoin, whatever, cryptocurrency is available 24/7. It never opens, it never closes. It's just always going on, and it provides unlimited day trading. We can utilize these graphs for cryptocurrency, and we can trade any dollar amount. If we want to trade $1, $10, $100, $1,000, it doesn't matter. So now we can trade during the weekend. We can trade during when the stock market's closed. It's a great way for us to practice our buying and selling signals when the market is closed. So, had to mute you there, Jennifer. Getting a little loud there. So the moving averages is part of those signals. It's part of our system. But if it's a system that you're not using, then we're just going to have to try to sell all at the same time. It just depends on you. So, but if you're not utilizing moving averages, you are leaving some money on the table. But again, you don't have to use
Carlos.
Yeah. What's that?
It's a quick question on the moving averages and Friday. So you went to Apple for Friday. Apple is actually a very interesting one, as it's one of the only tickers where the 5-minute EMAs, well, the EMAs did not cross on the 5-minute chart. But if you go to Amazon, NVDA, Baba, who are all in the top 5 for Friday, the 5-minute the EMAs crossed in the 5-minute chart is all at the same time. So signal to sell the calls and hold the puts. Or was that too early of a signal for you?
Let's take a look.
I mean, I made money in Friday, but I did sell my puts at that my calls at that 5-minute crossover, and then I sold my puts later on.
Yeah.
But I did not ride the high because I was out on no call.
Yeah, this is a great example where we do see a crossover on the moving average lines, and we see the crossover prematurely on the MACD. So right after opening, this is basically telling us to sell our puts no matter what's going on, whether it's a gain or a loss or whatever. But it's saying sell your puts because it's going to keep going up. If you're holding your puts, you're going to lose out on that, but you're going to gain on the calls. But we want to ditch the puts, whether we're securing gains or getting rid of a loss. We hold our calls until further notice, and we see that here it basically, it never crossed over after that. And so, but we still want to get out and reposition ourselves for the next day, no matter what. So get out of our calls, buy fresh puts and calls going into the next trading day. But yeah, no, this is a good one.
So basically, you're saying that 5-minute cross then that happened at 9:30 there, the first cross that opened, when the 5 minutes EMA crossed downwards, that we should have still held the calls. That was too early.
Yeah, because this is the pre-market, so we need to wait to see kind of what's going on. And it looks like it took quite a while. This was 30 minutes here. After 30 minutes, the stock started to slowly started to recover, and we can see that with the MACD. These colored graphs, like the red and the green, these and the lines on the MACD, these two lines are moving average lines. We don't have a price line in the MACD, but the colored bars, those are the gap distances between the moving average lines. So we can see that the colored bars are getting shorter and shorter every 5 minutes. So it's letting us know that be prepared that they could cross over, or it can also trend the other direction. And so it did right before.
All right, the sweat.
Say it again.
That's a sweat then. Holding both that long when you see it going down and open so much.
Yeah. So yeah, you should have gotten rid of your puts probably, within 30 minutes to 45 minutes after opening. Get rid of that, secure your gains, or minimize your loss on that, holding your calls until you're ready to sell, or until it tells us to sell, which it didn't up until towards the end of the day. Get rid of it, reposition, and then repeat the process over and over every day. And that's the beauty of utilizing this system, because the people on Wall Street and all these other professional multi-millionaire, billionaire companies and individuals, they're utilizing this stuff too. And if you guys are not, you're leaving money on the table. And so we can always practice, we can always go over this together if you want live here, or we can also do it together on while the market is open. That's why we have our live trading room as well as these meeting rooms. And so going back,
so I appreciate that. Sorry, Carl, just a follow-up.
Sure.
So what if it would have kept going down? At what point would you have dropped the call on Friday?
So on the next signal, so if it kept going down, we're going to gain on our puts, but we're losing on the calls to a certain point. Eventually, the puts will outdo the calls, and you'll be significantly ahead. But once, if something were to happen, maybe some other, if it starts to shift, we will see something just like this, but much lower down here, and that's when we would want to sell our puts and to continue holding our calls, because now our calls will be minimizing the loss. And then up until it crosses over again, then we sell our calls, and then we're completely out for the day.
So last question on Friday morning. So I take it. So you were able to hold those calls at open. How was your emotion? Were you sweating a lot, or were you still feeling good holding both sides through those first 30, 40 minutes?
I was a little nervous with Power Hour. I got out before Power Hour because I was anticipating, but nothing was scheduled during Power. There was no major, president's speech. There was no White House. There wasn't anything. So I knew that this was probably going to happen, but Power Hour was a little hesitant because going into the weekend, a lot of times investors don't like holding throughout the weekend because of weekend news that they can promote. Kim Jong-un firing more continental ballistic missiles, and we got Putin and so on. I mean, they could create all kinds of bearish activity. So I just waited to see what happens. That way, and then buying in the last 5-10 minutes and repositioning. But yeah, I got out like right over here, pretty much when it was at the highest point. We can see it started to kind of come down after that. So I did a pretty good job, selling it at right before Power Hour, and suffering.
And how are you feeling between 9:30 a.m. and 10:30 a.m.?
Well, at that point, yeah, it was very interesting to see, or to because we didn't exactly know what was going to happen. A lot of our economic reports were, I think, during pre-market, so this was pretty much the area that was affected by the economic reports. And then after that, there wasn't anything else that was going on. So it was pretty, pretty sure that the rest of the day was just going to continue this way because there wasn't anything else that was scheduled to happen. Yeah, it was just a matter of getting through the first hour of the morning. So going back to the differences between the amateur traders and the professional traders, that the amateur traders will often change their trading system after a few losing trades, because they'll go on social media and try to find, so, what are you doing? Or, I got $1,000, or where should I put it? Blah, 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 because they don't have a system. They don't have anything, so they're just looking for ideas and whatnot. And that's not good. We should always have some kind of, or several strategies, but we should always have our primary strategy, which is our straddling strategy, where professional traders like ourselves will stick to their rules religiously and think process oriented. We think process, not emotions. We gotta, we, as long as we're aware of our rules and our guidelines, and again, we think that it's a process that we have to, maintain, and not to go out of our process, because if we do, that is when we are jeopardizing our gains. That's when we can start leaving money on the table. That's when mistakes start happening, and we don't want to do that. We want to be consistently, we want to gain every day, we want to gain every week, and we want to gain every month. And where amateur traders will close their trades, never look at them, and avoid a learning effect. And that's not good. We always want to be learning, because the more we learn, the more that we're going to earn. Professional traders will analyze their past performance and keep a trading journal and learn from their past behaviors, but also to learn from maybe other people's mistakes. That way they're not making the same mistakes. And so the amateur traders will sometimes overtrade and revenge trade, especially, and hope to make a lot of money fast. And there's that word hope. There's nothing wrong with making a lot of money fast, as long as it's doing it the right way. And that's, straddling is doing it the right way. Because if you're a one road person, meaning where if you just pick one direction, a call or a put, yeah, you're gonna win some, but you're also gonna lose some too. And you're really not going anywhere, consistently, because you're gaining and then you're losing, you're gaining. I mean, your odds of picking one direction is really ultimately 50%. So if the odds are 50%, again, you're going to win, you're going to lose, you're going to win. You're not going anywhere. And so we need to win every single time, and that is something that we can manage by straddling. And so professional traders are aware of their emotional impacts and know how to identify and manage their impulsive buying and selling decisions, because it's all based off of a system that is process oriented. Amateur traders are open their trading platform and desperately try to find random trade entries. I got $1,000, where should I put it on? Whatever. They're just desperate because they want to try to find something. Where a professional trader will keep a trading plan and trade, or plan their trading day ahead, follow a structured approach, and that is what we're doing. We're doing a structured approach where we look at the economic reports that are scheduled to happen. We look at that. We look at the financial earnings reports that are scheduled to be reported, as well as what their analysts or what the analytics are showing, whether they're going to beat it or not, and this and that, as well as looking into the president's schedule, as well as their White House schedule. This is all a structured approach that we must do on a daily basis as well as a weekly basis. So the pro traders have this saying. They say, plan your trades and trade your plan. Benjamin Franklin says, if you fail to plan, you're planning to fail. And that is not us. We are always planning for knowing what each day is going to be like. If each day is going to be bullish or bearish, that way we know what's going to happen before it happens. And that is what helps our structured approach. So hopefully that helps. If anybody have any questions, want to bring anything to the table or anything at all, everything makes sense? You guys ready to rock and roll? All right, looks good. Again,
Ready.
Do you have any questions? Thought I heard someone. Yes.
When you're buying a puts or calls, and the strike price is like always, let's say the whole price is 64. It doesn't matter if it's 64.18. You're buying that whole price number, right?
Yes, yeah, it's definitely important, especially if you got a 64, you got a 63, $65 call and put strike price. If the share is currently at 64, go with the 64. However, there will be situations where it'll be right in the middle between two strike prices. Let's say we're at $63.50. Now I was like, now what do? We can go $63 strike price or $64 strike price. So what you can do, we can go like a $63 put strike price and a $64 call strike price. Now, the difference between a straddle and a strangle is that a straddle is always the same strike price. So your calls and the puts have the same strike price. A strangle is different strike prices. One is usually maybe lower and the other one's higher. But it's the same concept. It's the same where you're betting a stock goes up and you're betting it goes down at the same time. But usually we just call it straddling because ultimately we want to try to have the same strike price. But if it's right in the middle, then we definitely want to do the strangle, where you have you get your strike price one up and then the other one is one down. So hopefully that makes sense.
Okay.
And you'll notice that when you do that the values between the two are the same. Because let's say if it's at $63.50, but you get a $64 call and a $64 put, the call is going to be less expensive and the put is going to be more expensive, and we don't really want that because we want to try to keep it the same dollar amount, but we also want the same type of volatility. If you get it where it's a little off like that, the volatility is going to be a little different on both ends, and so that's why we want to try to keep the same amount of volatility, the level of volatility, but also the same amount of value.
When you're just picking either side, are you that face that time might be keeping a little cave?
I couldn't hear you very well. It was a little choppy for some reason, but it sounded like buying. Now, as we were talking about moving averages, usually for the safest way to buy, again, is within the last 15 minutes before close. But as a more veteran trader, someone who's more experienced, we can now buy at maybe different times based on the moving averages. But usually it's more beneficial if there's scheduled events that are taking place during power hour, like a press conference with the White House, or when the president starts to speak about something. Usually, like for example, if the White House has a press conference, they say whatever they got to say. But what really creates a lot of volatility is the journalist. When the journalist starts asking questions about Ukraine or North Korea or whatever, they could ask questions that can result in an answer that investors don't want to hear, meaning where it could create fear, and it could create where the stock market starts to come down. Well, maybe before the White House press conference, maybe we can start buying puts. Before the fear starts to get kind of out there, all of a sudden the stock market starts to drop during power hour. We see the signal within the moving averages. Now we have gains in our puts now, and then maybe within the last 5, 10, 15 minutes before close, we can buy our calls, and then when it goes to close, our calls are maybe at a 0%, but we just gain 5, 10, 15% on our puts. So now we got some gains going into tomorrow with our straddle. So that is a way that we can kind of buy at different times, before close.
Right, and then but when you're doing your day trading, let's say you see you're buying the dip or something, are you going to buy that call that is right there at that strike price, or you might buy maybe the next price higher, or are you just buying right at that strike price because it's basically like you're going to trade that stock, trade that option?
No, it's still recommended to buy at the share price. Yeah, whatever the price that it's at, buy at the share price, because just in case if it stops and doesn't grow anymore, than that, at least you're not going to suffer time depreciation. And sometimes, you know, if it's a someone that doesn't have enough buying power, and they will be like, well, I don't have enough for the same share price for the strike price, but I do have enough for one up from that, you know, and you get into that, and if it doesn't work out, you're suffering a lot of time depreciation, and then you're just like, oh, I wish I hadn't done that. So that's why, you know, you just want to try to stick with the ones that you can get into, that's more cost effective based on your buying power. But yeah, so I mean, it's just important that you know, maintain these guidelines and don't really, you know, break any of the rules, because you'll notice that when you do that, that's when, you know, bad things start to happen.
Yeah. And then, what are the best indexes that you want? Like the Dow, the semiconductor index, the NASDAQ. What's like the best group when you're getting your best sense of what the direction the market will take, other than obviously the charts and everything?
It's most common that people use the S&P 500. And we were talking about options earlier today, like ETFs. SPY, which is kind of like the stock of the S&P 500, is the most active one. It's the most watched. So again, as we always follow the money, you know, that is the one that other investors are also watching and day trading. So that's the one that we need to focus on the most. But when you look at the differences, like what are the differences between the two, the S&P 500 is pretty much the top 500 most valuable companies in the stock market. So now it makes more sense to watch that one, because the most valuable companies are all tied into it, versus all the other ones, you know, you just have a lot of, you know, small time, you know, companies, you know, pharmaceutical companies, you know, penny stocks, you know, those aren't really going to, you know, drive the market as much as the S&P 500, which has the majority of the most valuable stock market companies like Tesla, you know, Apple, Facebook, Google, so on and so on. So that would be the one that I would recommend based off of following the money.
Good. And cassette also has a mixture of the NASDAQ, the Dow, stocks, whatever's in the S&P.
Yeah.
Okay. Thank you very much.
Absolutely. Any other questions anybody have? Sorry it's taking so long, but yeah, any questions, feel free to unmute your mic. If not, we can always chat in the chat room later. If you don't have any questions, I'm assuming everything makes sense and you guys are ready for this week. Though we can go live tomorrow during pre-market if you guys want. That way we kind of go over some things while the market is open. If you want, we can meet in the trading room. Other than that, thank you guys very much. It's been awesome. We'll do this again next week.